Hi everyone, welcome back to the channel. Now, hope everyone had a great Christmas and an awesome start to 2024. I know I've been away for the last 3 months, really just been busy with traveling, work, and also just getting sick in the family. Finally, we've recovered and ready to start recording again for this year. And I thought for this year, to start off the year, let's make a video on the top things that you should pay attention to so you can have a better handle of your financial situation or financial plan. Now, these are going to be areas that I usually walk my clients through when I do actual planning with them. So if you want to have better finances than last year, then this is going to be the perfect video to kickstart 2024. Alright, so without further ado, let's jump into this week's video. The very first topic I think everyone should start with is budgeting. Now, you may be sitting here and thinking, well, I have a pretty good handle on my budget. I know how much I'm spending. I know how much I'm saving. I don't think I need to do my budget like other people. Now, nevertheless, this is still going to be a topic I recommend every single person do at least once to kickstart the year. Just because you're saving a good amount right now doesn't mean you can't save more. And more often than not, going through this with every single client, usually they would come back and tell me, while they may not be able to squeeze more saving out of their total budget, they're able to optimize the budget in a way that makes them happier by reducing spending in one category and shift it over to another category. Now here there are two types of budgeting that you should be doing. The first one is obviously to review what you spent on last year. There are really two ways to doing this. The first is the quick way where you just simply rely on credit card statements, which usually every card will summarize your spending for each category and just look at that and see if that makes sense for the year. Now, if you don't like what you're seeing or you think something is off, then I recommend you do one step further, which is to review every credit card statements since last year, line by line. Now, I actually only went line by line 2022. That's because looking at my credit card statements was a lot higher than what I expected. So I actually went and categorized it myself and realized what are some things I could have cut or could have done better for 2023. Now, we just did a review for our bills for 2023, and we were able to lower our expense quite a bit, even though we had a baby and we have some unexpected costs for last year. In my experience, these are the categories that either we have seen or our clients have seen where we usually overspend or we can save a lot of money on. The first one is obviously subscription. We reviewed last year and we basically canceled everything except for Amazon Prime and Disney Plus because we just don't have that much time to watch TV anymore. So there were no more Netflix, no more Crave, no more magazine subscription. Everything is gone. Second category we lower is takeouts or Uber Eats because they really do add up over time. Now, the third category is something we don't have, but our clients do see this quite a bit, or pet insurance because they do get more and more expensive quite quickly. Now, the last one is vacation. So 2022, we've actually spent a lot of vacation because, pregnant, we wanted to go before the baby came out, and we were just spending a lot on little trips here and there, and they really do add up. For 2023, we were working on this a lot by booking things way earlier to try to save money, looking for deals, and just that alone, we were probably able to save around 10 to 15,000. Now, once you have understand last year's budget and you understand where you want to optimize, then you can work on the second thing, which is this year's budget. So what you could do is actually set limit for each category that you aim to spend on. And what I would recommend you do is actually download an app called You Need a Budget. I believe there is annual subscription fee if you want to use the premium service, but hearing from our clients, they have really good feedback on this app. Now, once you have a 2024 budget that you like to aim for, you should be able to do your second category, which is saving. Usually what I'll do is take the budget that I have set or I can expect myself to spend every month and then apply that against my paychecks. That will give a free cash flow that you can expect to be able to allocate to different accounts for this year. Here, I would recommend you list out your major goals that you want to work with and assign a percentage for them. Now on the screen, these are the typical goals that clients usually set for themselves. Here, I would actually recommend you add two more. One is for buffer, and this is aimed to give you some freedom or wiggle room to kind of overspend because some months you're just going to spend a little bit more than the others. Now, another category I recommend is emergency fund if you don't have one for yourself right now. For single or young couples, you should aim for 3 to 6 months of spending as an emergency fund amount. And for people with kids, I would actually recommend anywhere from 6 to 9 months or even 12 months if your industry is extra volatile. And this is why I recommend you do budgeting first. Without that, you will not be able to know how much per month you're spending and able to set aside the correct emergency fund amount. And in terms of percentage, usually you can allocate whatever percent you think makes sense for you. Just keep in mind some for the long-term goals, you might be putting into accounts that are a little bit more restricted like RSP, and you don't have the ability to withdraw anytime you want. And if you have something very specific timeline-wise like buying your first home or retirement, and you really want to figure out the correct percentage and you're able to commit to it, you might have to do a little bit more math to work backwards, or talk to a CPA or talk to a planner to find an optimal amount. And finally, what's important here is once you have decided on the percentage and the account you want to allocate to, is to make sure it is automatically deducted from your checking account, usually on the same day you get paid or one day after. This is extremely important to enforce discipline on you, because if you don't get a chance to see the money sitting in your checking account, you don't have the chance to spend it. And this is how you can ensure over the long run, you've set up adequate saving for yourselves. And finally, if you have money left in your fund or buffer account that I've asked you to set for yourself, congratulations, that means you didn't overspend to the maximum amount you set for yourself. What you could do at the end of the month is take that amount and spread it towards your other goals, so then you can accelerate your saving for those accounts. Alright, once we have allocated a percentage, we need to talk about what to invest in. So another category you should be working on is investing. On here, I'm just going to give you a general guideline. I'm not going to tell you what to invest in because I believe it's different for every person. But generally, you want to do the following. Number one, understand your risk tolerance. There are a lot of risk tolerance questionnaire, or, as planner, we'll take our client through every time before we invest. Understand where you are in terms of risk tolerance. This will give you a good suggestion on what kind of investment you want to do or you don't want to do. And if you're new to investing, I would say stay away from individual stocks unless you have a high conviction, you've done your homework, you fully understand this company. Otherwise, I would say stay away from it, stick to funds or ETF. They're a lot more simpler for you to look at. Your portfolio should be simple. You don't need a million things to try to squeeze extra return here and there. Just keep things simple and easy to understand. And also try not to make too many changes once you believe you've set a right composition and a good portfolio. Unless you strongly believe that what you have picked is no longer good and fit your strategy, that's the only time you should be making a change. In my experience, after reviewing the last couple of years of my clients, usually the clients that done the worst in terms of return, looking at their DIY portfolio, are the ones that are constantly making changes when the littlest things happen to the market and they panic and they try to do something to fix it. The more they fix, the worse it gets. Now, my favorite phrase is time in the market is better than timing the market. So once you have set the percentage and a portfolio you like, just consistently put money into it. Don't try to guess the bottom or the top, because you're not going to be right every time, or most of the time actually. So just keep doing your thing, keep it simple, and you're going to have a much better outcome than probably 80 to 90% of investors out there. Alright, the fourth category we want to look at now is taxes. Now, before we do that, as a quick reminder, help us like this video. This is the best way to help support us. And also, if you haven't already, join my private Facebook group where you can ask more questions in there and you get more resources that other members are sharing. Now, usually January is the time I start reaching out to all the clients to start talking about taxes. You do want to give a little bit of room to yourself to estimate how much income you've made last year versus how much RSP you want to buy to lower your tax. Now, if you're a first-time home owner and you open an FHSA and fund it to the maximum $8,000 for 2023, you probably do not need a lot more RSP for this year. In fact, for the next 5 years, likely. If you have matching RSP to add on top of that, then it's even better and probably give you even less reason to buy extra RSP. But nevertheless, you probably still want to take a look first just to understand what bracket you're in right now. So how you want to do that is I recommend you getting your year-end pay stub, which will list out how much money you've made year to date and also all the other benefits, vacation, etc. And then from there, just enter those numbers into any online tax calculator, which will give you a good ballpark of where you are sitting right now in terms of tax. You can then find the province tax table for 2023 and then see where you are sitting right now, and keep in mind any existing RSP from your side or FHSA will lower your income already, and then see how much more you need to lower before you drop to the next bracket and whether you want to buy extra RSP to get there or not. Now, you do have until end of February to figure out how much more RSP you may want to do. Also, this is now a good time to buy the home buyer plan payback if you haven't already. You have to pay back 1/15 of the amount for every year, or 1/10 for any learner plan RSP that you withdrew. Now, I recommend doing this estimation for anyone with more than one job, or you're self-employed, or you sold an investment property and you have capital gain, or you own rentals and have rental income, or you just know this year you've gotten a lot of dividend or interest payment and you really want to figure out any tax owing so you're not caught off guard when it comes to April. And as always, if you're not sure, discuss with a CPA or plan to make sure you got the right numbers. Now, moving on, the second last category to look at are housing. There are two groups of people that need to pay more attention to this area. The first one is anyone planning to buy a property this year. For them, I recommend 3 things to start preparing on. The first one is a mortgage pre-approval to know how much you can borrow. The second is a down payment. Now, here I'm going to highly recommend not only making sure you have enough, but also to move them out and park them in somewhere safe without any volatility, somewhere like a money market fund or saving accounts, just so you don't want to be down like 10% right before you need to withdraw. And last one, this is something people often miss, and I talked about this in my previous older videos, is to simulate what is the true cost of home ownership if you're moving forward with this. Here, I would recommend you run several more scenarios to do things like higher interest rate environment if you're variable rate, or a higher condo fee than expected starting year 2, etc. just to make sure from a cash flow perspective you're ready. Start allocating the differences aside in a saving account right now to simulate as if you're a homeowner, just to make sure you're prepared. You should be doing this at least 3 to 6 months before owning your first home. Just so you're not going to be in shock when the payment starts jumping. Now, this is something we'll be talking about in my other videos, but I do expect a rate cut of somewhat this year. So that means mortgage rates should be coming down, and that also means your mortgage pre-approval should be going up. This also may signal real estate market heating up. So if you're planning to buy your first home, you may be entering a harder market than last year. So be ready on those 3 things that I just mentioned so you can jump at the first opportunity that you see. The second group of people that needs to pay attention to this are people with mortgage renewing this year. Right now, start deciding if you're going to use any lump sum to pay down your mortgages that will be renewing. Usually, the thought process is that if average return on your investment is higher than your mortgage rate, then you probably should be investing. If it is unlikely to be higher or just equal, then you probably should pay down your mortgage. Typically, if your mortgage rate is nearing 6%, you probably want to pay it off earlier just because it's a guaranteed 6% return after tax. Now, if you're paying down investment property, then the calculation is a little bit more nuanced than that because there is tax involved. So there's the after-tax return versus if you use something like TFSA, which doesn't require tax calculation. So you may want to speak to a CPA or planner to figure out the best course of action there. And finally, let's move on to the last category, which is will and power of attorney. Now, no matter what your family status is, this is something I highly recommend everybody start working on this for this year to have something, even if you have very little asset to give to anyone. In 2023, I have to deal with several clients passing away and I have to help settle their estate, provide information, etc. Now, some clients are under 30 actually, and even though they don't have a lot of complicated assets, just one bank account here and there, maybe one insurances, we're still delayed for almost 6 extra months just because there was no will in place, and so we had to apply through court through a lawyer for a letter of administration before we can actually settle everything. Now, you may be asking, why do we need that for insurance? I thought there is beneficiary. Well, it turns out that insurance company has the right to ask for a doctor's report, and without a letter of administration or a will, they can't proceed with that, and thus it is delayed. So no matter what, I would say get that done, get a will in place, get a power of attorney in place, just in case something happens. Now, if you have something simple like just putting a percentage to your family members, nothing specific, use something like on a Willful online platform just to get this set up first, and then you can see if you want to use a lawyer afterwards. Because Willful, I think it costs you maybe $100 to $200 just to get started, but a lawyer is definitely going to be anywhere from $600 to $1,000. Now, speaking of building a will, when you're doing this, I highly recommend on the separate side, either through Willful, which they have the dedicated list, or just use Google Excel, which is something I use. List out every single account and liability that you currently own, where things are sitting, and any specific instruction you have regarding those accounts or something to watch out for. This is going to massively help whoever going to settle your estate in the future to know where everything is. I recommend also telling your executor that you have such document and instruct them on where to find them if something happens to you. Not only is this going to be great estate planning practices, this is also going to be awesome to know your net worth snapshot every year. I recommend doing this, updating this at least once a year. I do this every January, just so I know for last year, for the whole year, how much my net worth grew or shrunk. And if I don't like what I'm seeing, or if I'm surprised by the number, then I can take a deeper look to see where everything is coming from. Alright, so those are the top 6 things that usually as a new client when they come in, I'm gonna run them through at least once just so we have a better idea. For you, there might be other categories like corporate planning, RSP withdrawal, all that stuff. But I guarantee you that if you at least start with these 6 things, you are going to have a much better handle of your finances compared to last year. Now, if you have other questions on how to improve your situation or some very specific questions you want answered to, you can either leave a comment down below or join our private Facebook group and ask there as well. There will be other members to help you as well. For next video, I'm thinking about talking about a new tax reporting law that makes adding joint name like your kids' name onto your properties or other accounts going to be extremely complicated and tedious and might trigger some tax implications. So I want to talk about that next video. This is a new rule that just came out. And if you like these videos, I do upload them every bi-weekly right now. So make sure you follow my channel, subscribe to it, and click the bell button so you get more notifications in the future. Alright, this is Jackie Cope. Hope you have a wonderful 2024 start and a lovely Christmas. I will see you in the next video. Bye!